to get up to do something on this side. Okay, hopefully that won't persist through the evening. We put up our polls later. Hopefully it'll let me control that from here. But I'm on campus, so that's why it looks a little funny here. But we are going to go ahead and game plan for tonight. Really is to finish up chapter 4. We had the discussion of goodwill impairment and see how far we can get into chapter 5. And of course, every time I put the machine into a tablet mode, it has to close everything for some unknown reason. Okay, and let's go ahead and start to talk about goodwill impairment. Now, remember, we talked about intangible assets, which goodwill is one. And we talked about intangible assets that are acquired from others that need to then be amortized, and it's over the shorter of the useful life or the legal life, whichever is shorter, of that particular intangible. And we said at that time that something like goodwill is something that is not subject to an impairment test. Now, it's not subject to the amortization, and therefore we'd have to evaluate it for impairment, I should say. So when we start to take a look at this notion of maintaining or developing goodwill, no, you do not capitalize any money you spend, okay, on maintaining or developing goodwill. So let's say you have this great training program and you're sitting there and you're training your employees how to give good customer service. And you say, wow, I've got all this goodwill built up, so I'm going to capitalize that. No. Let's say you acquire goodwill from a third party. Okay, now that you would be able to put on your consolidated financial statement, but you can't then start spending money to make the goodwill better or to maintain it. That gets expense. So the only goodwill that gets capitalized and put on the balance sheet is something that you purchase in an arm's length transaction from a third party. Okay. Now, when we look at goodwill impairment, okay, we're going to be looking at the reporting unit. Okay. So I want you to write right here in flashcard, evaluate each reporting unit separately. Okay. Evaluate each reporting unit separately. And we're going to look at an example here. We're going to give you a couple of different reporting units, and we're going to see that one has impairment of the goodwill, the other doesn't, but you have to evaluate each reporting entity reporting unit separately. And then definition of reporting unit, and they tell us that you have these operating segments, or one level below an operating segment. They'll make it clear in questions, what are the reporting segments? And then again, as I've already said, you may have one reporting unit that has an impairment of goodwill while the other does not. And we're going to actually look at a pretty good example of this here in a couple seconds. Now, we're going to be looking at quantitative evaluation of impairment, and you would want to do that. But there could also be a qualitative evaluation of impairment. So I don't know, maybe it's a entity that has had some sort of financial difficulty or product liability. Maybe it's an airline that has experienced some problems with their, equipment or whatever. And so there could be quantitative evaluation of goodwill that you would want to consider, as well as qualitative. Okay. So go ahead and flashcard the qualitative evaluation. Okay. Just in case they ask you, well, what would be the notion of qualitative evaluation? But let's just look at the quantitative evaluation. And again, the takeaway from this example is that you evaluate each reporting entity separately. Okay, that's what we need to keep in mind. That's the mantra that I had you put on that other flashcard. So let's go ahead and take a look. And we have this Omega company has two reporting units, alpha and beta. Again, we're going to evaluate those separately, which have book values, including goodwill of 500,000 and 675,000 respectively. Alpha reports goodwill of 50,000 and beta reports goodwill of 75,000. Now they tell us that as part of the annual review for goodwill impairment, Omega determined the fair value, including goodwill, of Alpha's assets were 480 and for beta 700,000. Okay, so beta got this 700,000, right? Now, when we look and just look down at the solution here real quick, we don't have to do anything else with beta. Why? Because beta's fair value of everything, including the goodwill, is more than its book value. There's no impairment. Now, when you look at what? When you look at alpha here, alpha is where the problem lies, and the alpha has 480,000 of book value, of fair value. Meanwhile, their book value is sitting up here at 500,000. So there is a $20,000 impairment here. That's the impairment of the goodwill. So what they would need to do is they would take that against the goodwill, 20,000, and they would debit loss due to impairment of 20,000. So now the goodwill would be what? The goodwill would be carrying at 30,000. Sometimes the problem will ask you what's the impairment or what's the resulting amount of the goodwill. Now the goodwill is showing at 30,000. Okay, if I were to tee that up. The goodwill is sitting there at 50,000, right? When we started this whole exercise, now we went ahead and credited it for 20. So obvious now the balance is 30. Sometimes the question will ask you that, or sometimes it'll just ask you the impairment. Okay. Now you would keep going like this year after year until you completely eliminated that goodwill. Anytime you have fair value that is less than the book value, you keep taking that against the goodwill until you've zeroed out the goodwill. Then you would, if there's still some amount of fair value below book value, then you'd have to start writing down various other assets. But you first go against the goodwill. Okay. Okay, good. Come down and let's take a look at a couple class questions and let's see how this is going to work for us today. Here's what I'm going to keep jumping down. Okay, guys, go ahead and take a look at this one. Okay, looks like most of us have had a chance to work this one, and so I'm going to go ahead and end the poll. And of the 8 folks that tried this question, most of us got it right. 7 of us got it right, which is choice C. But let's go ahead and let's take a look at this. And I think the choice B, I see what happened there. So that's an easy mistake to make. So let's just go ahead and let's look at this. Now, they tell us that the reporting unit had a book value of 345,000 or 3 million. With some of these questions from chapter 4, they have gigantic numbers. 3,450,000 is the book value, and that included goodwill of 225 as part of its annual review. So goodwill, let's just look at that. Goodwill is sitting over here with a balance of what? Of 225,000, right? Okay. Now they tell us that as part of its annual review, goodwill, the entity determined that the fair value of the reporting unit, including goodwill, was 3,310,000. So we have impairment there because what's happened, our fair value has fallen below our book value. We have impairment of what? 140,000. Okay. Now the journal entry here would be to debit the loss 140, which, by the way, is the answer to this question, and credit what? Credit the goodwill 140. And when we credit the goodwill 140, if I'm not mistaken, the book value comes down to 85. Is that right? So that's probably where the person that chose 85 got 85 from. So you got to be careful because there are some questions where they will ask you what's the resulting value of the goodwill, and then the answer would have been 85. But here they wanted to know the loss. What are we going to credit to the goodwill? Question. Okay, good. There's no question on that. Let's take a look. Oh, that's it. That's it. What did you? Okay, that's all right. Okay, they just gave us that one. Any question on that? Okay, good. Then we are done with chapter 4. So let's go ahead and jump ourselves into chapter 5. I'm thinking we can probably make some pretty good headway into chapter 5, I hope. I'd like to at least get all the way through bonds tonight, but let's just go ahead and see how we do. And let's take a look at our liabilities now. So we spent, and notice, guys, in the first couple of classes, we were hovering around the income statement. Starting chapter 3, we started dealing with the balance sheet. Chapter 4, we looked at investments, which was a balance sheet item, but then we also went to consolidation, since as you buy more and more of an investment, that takes you into the consolidation. Now we're going to start to turn our attention to the liability side of the balance sheet. We'll be there for chapter 5, chapter 6, chapter 7. We start dealing with stockholders' equity. Chapter 8. Okay, we start getting into the statement of cash flows, not for profit. Chapter 9 and 10 are governmental. By the way, governmental is going to go to the bar part of the exam. I know that some of you might have been interested, and I'll see if I can get the recording and post that for you. The bar part of the exam for starting, when the new exam starts in 2024. But for you, you're going to knock this out and you're going to see that the governmental stuff is pretty straightforward. A lot of people worry about governmental. I would not worry too much about the governmental. Okay, we'll get you through that. Okay, now we'll talk about payables and accrued liabilities. I find that a lot of these questions in that area tend to be more reading comprehension than they really have anything to do with accounting. And I'll show you how, what I mean by that as we get to some of that. When we deal with contingent liabilities, that's about 5 points. Okay. Then we start to get into long-term liabilities. And really what they're talking about is bond payable. Bond payable has long been a heavy area on the exam, 10 points. And so we're going to need to worry about that. And then probably next time we'll finish up the discussion of troubled debt restructure. That's about 3 points. For some reason, I find this area fairly straightforward, but the troubled debt restructuring, but I get a fair number of comments on Facebook. I don't get them, but I see them on Facebook about how much trouble people are having with that. I'm like, it's not that hard. Okay, it's just a matter of knowing what discount rate to use for various items, and we'll work on that probably next time. Okay. All right, good. Now, when we look at liabilities, of course, as we saw for our assets, we will be able to classify our liabilities into whether they are current or non-current. Okay. They involve probable future sacrifices of economic benefits. Often the sacrifice of a future economic benefit is going to be what? Cash. So if there's some point in time that you're going to have to pay cash out, then FASB says, well, then you're going to have to recognize a liability for that. Okay. Now, when we look at current liabilities, those are going to become maturing and having to be paid probably with cash, either in the next year or the operating cycle, whichever is longer. Some operating cycle basically saying, well, how long does it take you to convert your assets into cash? And if you're something like a winery, I guess, yeah, it probably takes you more than a year to convert your inventory into cash. Grapes in the field to wine takes more than a year. And so maybe you'd have a operating cycle, which is longer than 1 year. So your current assets and current liabilities could be those that won't mature until a couple of years. But the rule of thumb is 1 year in order for it to be current. Okay. And typical current liabilities are going to be things like your cash is current asset, but things like your payables, your salaries payable, that sort of thing. Okay. Now, when we talk about accounts payable, okay, accounts payable, you can use the gross method, which means that you're going to assume that you will not pay that invoice within the discount period, or the net method in which you assume you are going to take the discount. Now, this is the flip side, the mirror image of what we talked about for the gross method and the net method when we were dealing with receivables. Now we're the one that is what? Purchasing the item, probably inventory, and we're going to record that either gross or the net method. Okay. But it's pretty straightforward, guys. I think you know this, but let's just quickly review that if you had what, $5,000 worth of inventory that you purchased, terms were 210, net 45 in this example, meaning, hey, you're going to have to pay that whole amount. If you go past the 45 days, if you go to the 45 days, if you pay it in 10 days, then you can get, in this example, is a 2% discount, right? So what happens? If you record at the gross method, then you're going to go ahead and debit the inventory, and for the full 5,000, credit the account payable. And then if you pay within the discount period, okay, then you will go ahead and you will debit the account payable, credit the cash for 4,900. They have you here in this example, credit purchase discounts, but purchase discounts ultimately gets closed out to inventory. So at the end of the period, you would debit the purchase discount account, credit the inventory to bring the inventory down to that amount of cash you actually paid, the 4,900. Now, of course, if you use the net method, then you would go ahead and you would do what? You would just basically take the account payable 49 and credit the account payable at 49. And then if you pay within the discount period, debit the account payable, credit the cash for the 49. If you go past the discount period, now you're going to have to credit cash for 5. You would credit the account payable for 49. And that additional amount you paid, the $100 in this example, would go to the inventory account. Okay. But you can see that stuff is pretty straightforward. So let's go ahead and let's take a look at our current portion of long-term debt. Okay, let's just look at that. Okay, now what happens? If I have a long-term debt and I may be paying that in installments, and then what? Some of the installment is going to be coming due in the next year or within the operating cycle, then I will literally have to sit there and reclass some of that debt out of long-term and into current. Okay, now, if I have something that is coming due, Okay, I have a short-term obligation. I can exclude it from my short-term items if I meet either of these criteria. Okay, and so let's go ahead and flashcard these criteria. There has been the actual refinancing prior to the issuance of the financial statements. So I sit there and I refinance this January, and I'm not going to issue the financial statements until February. Then on my December 31st financial statements, right, December 31st, 2023, I'm sitting there and I'm saying, oh, I've got a portion of my long-term debt that's going to come due, say, next year. And then I'm able to refinance that, and I complete that refinancing, even though it's January, say, of 2024 now. If I'm not issuing my financial statements until February of 2024, then I could literally keep that portion of that long-term debt in the long-term section because I've refinanced it for a longer period of time, of course. Or the existence of a non-cancelable financing agreement from the lender having the resources to accomplish that. Okay. And so I can literally go ahead and take amounts that would have been shown as what? As a short-term liability, debit the short term for the amount I was able to refinance and credit the long term. Okay, so go ahead and flashcard that. And that's kind of an interesting thing in that usually we say that accounting is based on a past transaction or event, but here they're actually letting us make a journal entry, right, for something that happened, what, after the date of the financial statements, but before they were issued. You don't see a lot of those sort of things in accounting. So go ahead and flashcard that. Okay, now accrued salaries and wages payable and unpaid portion of salaries and wages, they are reported on the balance sheet. And that's basically when we have, pay period that overlaps the balance sheet date. I don't know if that's even worth highlighting. I think we all know that. Okay, let's look at taxes payable though. Okay, because you do see some tax payable questions on the exam, and we see the property taxes. Okay, and property taxes are often invoiced in arrears. And there are two methods for the accrual. Okay, and let's flashcard those. Property taxes payable may be accrued prior to the receipt of the tax invoice and matched in the year in which the invoice pertains. So they're sitting there and they're saying, well, you're not going to get billed for this year's property taxes until later. You could go ahead and estimate what you think the correct amount is and take that liability in the year to which it applies. But property taxes may also be recorded as a payable upon the receipt of the tax invoice. So now you wait to get that tax invoice that may apply to a previous year. It could be expensed in the year of the receipt, as long as either method is acceptable, as long as it is consistently applied. So that's why I say for some of these questions, guys, they start to become more reading comprehension than accounting. If they tell you that they take the invoice and they wait till they receive the invoice, and they'll take that in the year that they receive the invoice, then you just go ahead and do that. If they tell you they estimate in advance, then you would go ahead and do that. Okay, now you come over and let's take a look at sales taxes payable. Okay, that is also a liability, obviously. And so you have cash sales, whatever the cash is that you collect. Some of that is revenue, but some of that you'd owe to the, in the state of California, it's the State Board of Equalization that you would then need to send, and remit those amounts to. By the way, not a bad career opportunity if you want to look around for things in government is the State Board of Equalization in the state of California, and maybe it's equivalent if you're in another state, because what happens is you look at businesses and you look to see how business recognize their revenue, so that then you can go ahead and do what? Have the appropriate taxes being taken for the sales tax. And that is a good way to learn a lot about a lot of different industries in a very important area, which is your revenue recognition, right? Okay, good. Now we come over and they talk about these different payroll deductions, guys, and very basic stuff, and that you'd set up the payables for the different withholding for federal, okay, other withholding of, for state and federal. And then, of course, there's also the employer's share of any payroll tax. Okay, so if you see some questions like that, you would just simply be knowing that you need to set up a payable for whatever those various taxes are by the various taxing authorities. Now, bonuses are kind of interesting because with bonuses now, you start to get into a situation in that the bonus will be paid after you have considered taxes, but the tax that the company has to pay is after the bonus. So I find this kind of fun because you're really kind of sitting here and doing, intermediate algebra to be able to answer something like this. So let's just go ahead and let's take a look at how this would work. But they tell us that X Corporation offers its vice president bonus equal to 10% of net income after deducting taxes, but before deducting the bonus. Income without taxes, or the bonus is 100,000 and the tax rate is 40%. So you just read that and you say, okay, well, first I'm going to set up what the bonus is, and it's 10% of the income after taxes. The taxes are going to be 40% of whatever the income is minus the bonus, because a bonus is a legitimate business expense, right? So what happens? You sit here and you say, well, if that's the case, then the bonus is going to equal, and we say 10% minus the 100,000 minus, and the tax here is what? The tax, and you just take whatever we said for tax up here, change the color on that, 40% of the 100,000. Okay. I guess there is no way to change the color on that one at this point. Okay, and that gives me what? That gives me 40% of the 100,000 minus the bonus. So now we just solve for what? We solve for B, and the first thing they do is they simply apply the 10% to the entire equation here. And so when they do that, they get what? The bonus is equal to 10% minus 40,000 plus 40%. So they're just going ahead there and applying the, the 40%, this part right here. Okay, they're just applying that using the distributive law of multiplication. And then they go ahead and they say, okay, now let's apply that 10% to all of that. And when they do, they sit there and they say, well, 100,000 minus 40,000 is 6,000. 10% of that would be 6,000, and 10% of the 40%, again, distributive law of multiplication, would make that 4%. And now we just do a very simple algebra manipulation, subtract 4% of bonus from each side. 96% of the bonus is equal to 6,000. Divide each side by 96%, right? By 0.96. And that means the bonus would be 6,250. I don't know. I look at that and I think, okay, that might be kind of fun to work a problem like that. And you'll see some problems like that, not that difficult. Okay. All right. Now, accrued vacation. And they tell us that accrued vacation, okay, vacation is recorded in the year earned if all of the conditions are met. The employer's obligation to compensate for the accrued vacation is attributable to services already rendered. The obligation relates to rights that vest, okay, to one or more accounting period. Payment of the compensation is probable and the amount can be reasonably estimated. So you have to meet all of those criteria. If any one of those criteria, if any one of those conditions are not met, then you would have footnote disclosure only. So make sure you flashcard that as well. Okay. Now you come down and that's vacation. And when you look at this, notice, guys, that you record the liability and the expense in the period in which the vacation is earned at whatever the rate is at the time they earned it. Even though they may get a raise when they finally take that, we'll record that additional amount as an expense when they actually take that. But let's just look at this example. And you've got this Tanny company began operations and can earn 4 weeks of paid vacation for each year of employment. Unused vacation time is carried forward and paid at the current year's salary on the balance sheet. In year one, James had taken no vacation. His salary at December 31st, year one, was $300 per week. He should get another job. In year two, the salary increased to $400 per week. I don't know, I guess I shouldn't make, cracks about what a person's making, but calculate the amount Tanny company should carry as a liability for James accumulated vacation time and prepare the entry year one and year two. So what happens when they earn the vacation? We take the 4 weeks times the $300 per week, debit the expense. That's so that the expense is being taken in the period that they actually earned that, right? And then go ahead and credit the payable. Now, what happens? The guy finally gets around to taking the vacation. I guess it's a guy, James, and they go around and they finally take that vacation that they earned in year one and they take it in year two. But by year two, they're making what? By year two, they're making $400 a week. Not a problem. Multiply that, that 300 times the, I guess they have 4 weeks coming now. I don't know where it told us they took the 4 weeks, but oh, here it is. They take the 4 weeks in year two. Okay. So we have what? We have the 4 weeks times 400. Okay. So we're going to have to pay the guy out what? 1,600, but 1,200, that is liquidating that 1,200 we had set up that was earned the previous year. And we're taking 400 as expense of this year because that's in year two in this example, because that's when the person was being paid that higher amount. Okay. Now, you come down and they show you accrued vacation. They don't talk about sick leave here. The thing about sick leave is it is often difficult to do what? To estimate this amount. So sick leave frequently is not going to be accrued because it's hard to know when people are going to take sick leave and whatnot. It's not that, it's that it probably it's hard to estimate it, and not the exception of what you're supposed to do if you don't meet one of those. The reason sick leave typically doesn't get recorded is this. Some companies do. I sometimes wonder why a company goes through a lot of trouble to create a liability that FASB's sort of given them an out on, which is, hey, if it's not easy to estimate, then you're not necessarily going to have to record that. Okay. Or I shouldn't say easy to estimate, but if you can't reasonably estimate it. Okay. Okay, good. Now you come over and we talk about exit or disposal costs. Now what happens? Let's say I'm sitting there and I have a contract to rent something, and it's a certain size or whatever, to rent. And I have a contract with you that I'm going to rent a room from you for the next 2 years at $300 a month. And then all of a sudden I realize this room is not big enough for me. I need a bigger room. So now I need to what? I need to get out of this contract, right? Okay. What do they tell us? Well, we're going to have to look at any costs associated with that, trying to get out of that contract. So costs associated with exit and disposal include involuntary employee termination benefits, cost to terminate a contract that is not a lease. If it's a lease, then we go through a whole nother process, and we're going to get into leases next time. Other costs associated with exit, including costs to consolidate facilities or relocate employees, et cetera. Again, maybe I'm going to go to a smaller building instead of a bigger one. Okay. Now, let's go ahead and take a look, though, at involuntary employee termination benefits. And I'm drawing an arrow over because I want to go ahead and just show you the example here as to what we mean by exit and disposal activities such as involuntary employee termination benefits. And so when we say involuntary, the employee is involuntarily being terminated. Okay, they're being let go, laid off, whatever. And so an entity plans to close its facility to a particular location and determine that it no longer needs 100 employees to work at that facility. The entity notifies employees that they will be terminated in 6 months. A termination benefit will be provided to each employee totaling $5,000 on the date the employee starts working. On the communication date, we will have to set up a liability of $500,000. That's 5,000 times the 100 employees. 500,000. We'll set up that liability and we'll take that expense on the date that we have communicated to them that that's going to be the case. Okay. Now, come back though, and let's see what the criteria are for that liability recognition. Okay. And commitment to an exit disposal by itself is not enough to result in a liability. We have to meet all of these criteria. Okay. So let's flashcard that. An obligating event has occurred. The event results in a present obligation to transfer assets, and the entity has little or no discretion to avoid that future transfer. So, if you had some sort of deal where I had a contract and I'm saying, I don't want this contract to go on for the next year. I need to get out of this thing. And the guy says, well, then you're going to have to pay me, a cancellation fee on this contract of $500. I really don't have much discretion in that. So I'd have to take that liability. Okay. Future operating losses expected to be incurred as part of the exit are recognized in the period they are incurred. Okay. So if that's going to be some amount where I'm, continuing into the next year for about 6 months before I finally, get out of this contract, and I'm going to be taking losses in those next 6 months on the operation of that facility, whatever, then that is not part of the exit disposal loss. I would ignore that and just treat that as a regular operating expense. Okay. Now you come down income statement presentation. And if I'm incurring these disposal costs as part of a discontinued operation, then that goes in the discontinued operations section of our income statement, going all the way back to F1, guys. Cost associated with the exit or disposal activity not related to discontinued operations is part of my continuing operations. Okay, so only put it, because the exam will love to try to trick you on that, only put it in discontinued operations if they're sitting there and saying that it's part of a discontinued operation. The following footnote disclosures, guys, just flashcard the footnote disclosures. I'm not going to read off a litany of footnote disclosure requirements to you here. I don't see that you get much out of that, but I do think it's worth flashcarding because sometimes the exam will say, well, if you have exit disposal activity, what needs to be disclosed, have a flashcard there, or if you already see that in your Becker flashcards, that's fine. Okay.
What would the journal entry be for the termination benefit?
For the termination benefit, there would be basically an exit disposal loss. No, I've done it up as I'm famous for doing. I didn't give myself enough room to write the journal entry. There would be a debit to exit disposal loss for 500,000. Since it's a loss, it goes where? Where do we report losses?
Income statement.
Income statement, yeah, and it would probably be non-operating, but it could be, probably be non-operating exit disposal loss. Okay, could
because
be.
They're closing the facility. That's why it's not operating.
I don't see that, kind of getting out of a contract as part of the normal course of business. So that's why I'm thinking it probably wouldn't be, it wouldn't be, operating expense. Okay, so
Mhm.
remember, we have what? We have operating items, we have non-operating items, we have tax, and then we get into the discontinued operations, which is a whole nother thing. When you're getting rid of an entire segment of the business or something.
Yeah.
So I can't tell from this whether this is getting rid of an entire segment. I'm assuming not. Okay, and so that would be reported in, I'm saying here, the non-operating section. And then you would credit the liability, whatever that liability is, disposal, exit disposal liability for 500,000.
Okay. Thank you.
Of course, shows up on the balance sheet. Yeah, how exactly that gets classified, I'm not sure that the FASB gets up in your face and says exactly how you have to classify that. I think if you had, as part of your business, you were kind of getting in and out of contracts all the time, I could see that being a normal course of business. But to me, this sounds more like not a normal course of business. Something's happened that has caused you to have to do this. I'd put that in the, well, what did they say up there? They actually told us. Or they say where to put that? Income costs associated with extras related to discontinued operation reported in costs associated with extra disposal not related to will be reported in income from continuing operations, which doesn't tell me if it's operating or non-operating, which is what I'm saying. So it could be either. Does that make sense? I'm not sure who's talking.
No, that's great. Thank you.
Yeah. Okay. Okay, good. Now you take a look at the asset retirement obligation. What happens here? I was on an assignment with the GAO a long time ago. We were looking at the Office of Surface Mining. The Office of Surface Mining is a federal agency that's required to make sure that companies like coal companies and stuff clean up their mess after they're done taking all the coal and stuff out of the ground. Now, what was irritating about that assignment is that I learned that often coal companies don't clean up their mess. They just walk from their responsibility. And the only tool that the Office of Surface Mining has is to revoke their license for getting coal out of the ground. But then what the same individual persons, the human beings do, is they just go and they form a new corporation. And the Office of Surface Mining can't pierce the corporate veil to go after the same individuals that committed the crime. So they essentially walk on their obligation to clean up, and the federal government gets stuck cleaning that stuff up themselves. Now, it's interesting that, and I didn't think about looking at this on the time of the assignment. What's interesting is that the accounting requirements say, well, no, if you have some obligation to clean something up and you're a coal company, you'll book a liability. You're going to have to estimate what you think that liability is going to be, and you're going to have to estimate that liability and book that liability. And then as you move through the process and you start to take the coal out of this mine or whatever it is, you're going to have to recognize the depreciation for that. And you're going to have to also recognize that you're getting closer, that you're having an accretion towards that liability that you're going to have to pay off at some point in time. And what I wish I would have thought of at the time is what the federal government should do is make these mining companies and whatnot put the money in escrow for whatever it is that they're moving towards that liability. So if they move, they try to walk from their responsibility, at least the federal government has the cash in hand to go and do the cleanup. But I didn't think about that until later. And I always call those audit flashbacks that I have later. I'm like, why didn't I recommend that they have to do that? Because they are having to make that adjustment to their liability as time moves forward. So you have this mining industry, and they tell us that they have to take an asset retirement obligation is recognized when it meets the definition of a liability, duty or responsibility, no or little discretion to avoid. And guys, just walking from the problem and not not following the law and knowing that you're going to get away with it is not discretion. If you're legally obligated to pay and then you have some legal maneuver to get out of it, that's not reason not to take the liability. And then there's been some obligating event. Now, you take a look, and when an asset retirement obligation exists and qualifies for recognition, an entity records an asset and a liability on the balance sheet to equal the fair value of the asset retirement obligation. FASB's doing this because they're kind of trying to help these companies along to do this, because they don't want to have them take this huge liability all of a sudden and sink their balance sheet all in one step. So they make them take the liability, but they also do what? They also let them take an asset at that point in time. And so the net worth of the company isn't destroyed by the recognition of this liability that maybe won't, come for some time in the future. Okay, so you go for some time further in the future. So you go ahead and you can flashcard that. The fair value is generally equal to the present value of the future obligations. And if a reasonable estimate cannot be made, then the liability and related asset are recognized when a reasonable estimate for fair value can be made. Okay, so flashcard that. We're going to put an asset and a liability equal to the present value of whatever the future obligation is. So come over, and when we do that, okay, the journal entry is to debit asset retirement asset and credit the liability. And that basically has a nice little balancing that happens on the balance sheet as a result of that. Now, from that point forward, after we record that asset and liability, we will have to calculate an accretion and depreciation expense. And so the period after, we'll go ahead and adjust accretion expense due to the passage of time, and the asset retirement cost will be depreciated. Okay, so we're going to depreciate the asset. It's sort of like amortizing the liability, but they call it accretion. Okay, so let's take a look at the accretion expense, and it is the increase in the asset retirement obligation liability due to the passage of time, calculated using an appropriate accretion rate. The exam will give you the accretion rate if they ask you about that. And that happens each period. And each period, they will debit appreciation expense and credit the liability, essentially moving that liability up to whatever it is I'm going to have to cough up in cash once I have to go ahead and start to clean up this mess. Okay. Now, the depreciation expense is whatever the life of that asset is. Okay. And we'll divide that using straight line, take the depreciation expense and credit accumulated depreciation, which you've known for a long time is the entry for depreciation. Okay. Now you come over, and I know that a lot of that is like, kind of hard to comprehend. Okay. But let's go ahead and let's just take a look at this example, and I think you'll see that it is a little easier to understand when you have some numbers on it. So January 1st, year one, this mining company purchased an existing coal mine and expects to operate the mine for 4 years, after which it is legally required to dismantle the mine. Don't worry about the fact that a lot of companies walk on that requirement. Brown estimates that it will pay $500,000 in year 5 to dismantle the mine. Brown uses straight line depreciation and accretion rate of 10%. As I said, the exam is going to give you those numbers. The present value of $1 at 10% is 0.6381. And so I go ahead and I get the present value of that $500,000 I'm going to have to pay out in year 5. Okay. And I use the present value to set up that asset and set up that asset retirement obligation. That's a liability. So they let you take an asset, but they also have you take a liability. And then I'm going to depreciate the asset, and I'm going to, they don't call it amortize, they call it accretion, but essentially amortizing that liability. Okay. So when I look at my accretion expense, I go ahead and I multiply that liability, the beginning balance times the 10% accretion rate. That means I have an accretion expense of 34,000, and the depreciation is easy enough. It's just whatever the asset was divided by the 4 years. Now I go ahead and for that depreciation expense, let's look at that first because that's pretty easy. Debit depreciation expense, credit the accumulated depreciation. For the accretion expense, I debit that, it's an expense, right? But I credit the asset retirement obligation. That's that liability. That's that liability up there. I go ahead and I credit that because I'm essentially amortizing that up towards that 500,000 using that accretion rate of 10%. Now I'll continue to do that year after year. And as I do, notice what's going to happen here. I'm going to go ahead and have my asset retirement cost, okay, would be what? If they ask me at the end of, say, year 1 here, the asset retirement cost, the asset is going to be whatever the original amount I recorded minus the depreciation I took, right? And then for the liability, it's going to be whatever the beginning balance of that liability was, the 341 plus what? Plus the amount that I increased the liability with that credit. And that will go on, okay, period after period, okay? And as I go ahead and I take these accretion expenses year after year, I have total accretion expense of 158,495. And now the liability is what? Is to the 500,000 as I've added those accretion expenses to the liability account year after year. Notice my total expense now is what? The depreciation plus the accretion expense that I took period over period, or what? 500,000, which is the amount of the liability by the time I get done with this whole thing. So I've done what? I've taken all my expenses, my accretion expense and my depreciation expense. And then when I go ahead and I finally pay that thing off, and assuming that, the dollar amount was more in this case than I had to pay, then I had to set up as a liability, I should say, then I would, of course, credit the cash and debit the liability, and then I would take an additional expense for any additional amount. If it was less, I would debit the liability, credit the cash, and I guess there'd be some sort of negative expense for that at that point in time because I would have, paid less than I thought the liability was going to be. I mean, the thought that I had was, I don't understand why the federal government can't, because the big chunk here would be what? Would be this 341,505 if you made them put that whole amount in escrow. But I don't know why they can't make them put a certain percentage of this amount in escrow, the mining companies, the coal companies, make them put some amount of that big liability that comes up, put some amount of that into escrow, and then at least make them take what? Make them take the accretion expense part each period and put that in escrow so that the federal government isn't left just holding that whole bag at the end to pay this, 510,000 to clean the thing up because the company walks on it. Anyway, that's beyond, what you need to worry about. Just know that they have that liability and they have to set that up. That liability grows as the asset shrinks over time. You take all of that into expense, and then at the time you liquidate the liability, right? When you actually pay. Okay. Okay, good. Let's go ahead then and let's take a look at this question here. Okay, guys, we're up on 2 minutes, and it looks like most of us have had a chance. Looks like somebody's not participating for some reason. There we go. Okay, looks like everybody's had a chance to look at this now. And okay, most of us got this right. 80% of us, a couple of us had a little trouble with it, but let's go ahead and let's take a look. And this is a little bit annoying because we didn't really talk about how you would attack a problem like this and any of this stuff that we've discussed, but let's go ahead and let's just roll with it here and see what they're telling us. And they say Paisley, I guess, not Parsley, Paisley Incorporated borrowed $2 million from State Bank on March 1st, year one, at a rate of 6%. According to the loan agreement, Paisley must make principal payments of $200,000 plus appropriate interest payments every March 1st until the loan balance is paid off. Parsley has made the principal and interest payments since the loan began. The interest that we should report on year 3 balance sheet, I mean, not the interest, but the payable that we should report on the year 3 balance sheet. Now, typically, guys, questions shouldn't make you go more than through 2 years of dealing with the amortization of a liability, maybe 3 years. Okay, they don't typically sit there and string you out for 5 years. Maybe in a task-based simulation, they might make you do 5 years of an amortization, but probably not, probably maybe just a couple, 3 years at the most. They just want to see, do you get it? Okay. And they don't want to sit there and see, can you go, 15 rounds with a heavyweight here? So you start to look at this and what happens. The thing was $2 million. They told us that they pay what, $200,000 per year. Okay. So what happens? They would have paid $200,000 in year 2, and that's on March 1st. Okay. And then in year 3 on March 1st, okay, I'm putting the year before the day, they would have paid. Okay. So what happens at March 1st, year 3, they're left with what? As soon as they make that payment, they're left with $1,800,000 on that. $1,600,000. Subtract 200,000 twice, John. 1,600,000, and they tell us that the interest rate on that is what? 6%. Now, be careful, guys, and maybe that's where some of you made the mistake. The easiest mistake in the world on the exam is to miscount your months. Okay, be careful. Okay, it's what? It's all of March, April, May, June, July, August, September, October, November, December. That's 10 months. If you have to count on your fingers, in fact, I think you should count on your fingers to count months, then do it. Okay, when I was studying for the CPA exam, I always counted on my fingers for questions like this, March, April. And my dad would watch me study. So what are you going to be, a CPA that counts on his fingers? And I'd be, for a question like this, yes, I am. I'm going to count on my fingers to make sure I'm not making a mistake and saying it's 9 months because March is the 3rd month or something instead of using the 10 months. And I don't know, maybe that's where the 100,000 came from that some of you picked. Okay, so the answer ends up being what? 80,000 when you do the math on that. Is that where 100,000 came from if you use the full? No? I don't know where 100,000 came from. I don't care. If you're not going to answer, I'm not going to care. Okay. All right, good. Let's go ahead then and let's take a look at contingencies. Okay. Now, what happens? Even though we don't necessarily know for sure that we're going to have a liability, we will need to take loss contingencies. Now, before we get into the specifics on that, gain contingencies, and they tell us that what? Gain contingencies should not be recognized. That means what? No journal entry. Okay, they should not be recognized. But if you have a gain contingency, you can put that in the notes to the financial statements. Okay, but don't be misleading. which that's always the case. Okay. So flashcard, there's no recognition of gain contingency, but you could disclose it in the notes. Okay. Now, when we're dealing with loss contingency, which is really where we want to focus, then there is some chance that we will have to book that. We will literally have to make a journal entry, and we make that journal entry when it is probable and estimable that there will be a loss. If we have a reasonably possible loss, then we're going to have to look at the disclosure on that. If it's remote, we don't have to put any kind of disclosure or anything around that. Okay, so let's take a look, and let's take a look at the rules here. And if it is probable, okay, dealing with probable, that as the date of the financial statements, an asset has been impaired or liability incurred based on the information available prior to the issuance of the financial statements, okay, then we will have to go ahead and accrue that loss and make a charge to income. So we will literally set up the liability and we will debit income if it is probable. Okay. Now, what happens if the amount of loss has to be reasonably estimated? Okay, so it has to meet both of these. It has to be probable and reasonably estimated. But in the event that the range of probable loss is given, GAAP requires that the best estimate of the loss be accrued. If no amount in the range is better estimate than any other, then the minimum amount, the 100,000 in that case, should be taken, and a note disclosing that there could be a loss as much as 500,000. Okay, so flashcard, both of those things, has to meet both criteria to take the loss: probable, estimable. But then when you get into the estimate, you should take the best estimate. If it's a range, take the lower amount, but footnote that it could be as high as another amount. Now, if we're talking about a loss that is reasonably possible, okay, in the event that the loss, both of the conditions are not met, probable and estimable, okay, then the financial statement should disclose an amount that the loss or additional loss may have been incurred, what is the nature of the contingency, and an estimate of the possible loss or range of loss that cannot be made. So you move to disclosure. Now, let me point out something that's confusing. Sometimes they'll say that the loss may be probable, but if it's not estimable, they don't want you to go and just start, booking amounts, that are crazy and you have no idea what the range is. Then they tell you what, then go ahead and just disclose that. Or if it's only reasonably possible, then disclose that. Okay. So they don't want you to just book an amount in the financial statements when you have no idea what the amount can be. If you have a range, yeah, book the lower amount of the range and disclose what the upper amount of the range is, or book the most reasonable, most likely amount of what it's going to be. Yeah. But if you're just sitting there and you're like, I have no idea what the loss is going to be, then you move back to disclosure, or if it's reasonably possible. Okay. If the loss is remote, then you don't have to do anything. No disclosure. And of course, you don't have to, sit there and come up with any estimates if it's remote. Okay. Okay, good. Let's come over then and let's take a look at a couple of different things here. And unfortunately, this example is like horrific. I wish they would come up with a different example than this horrific thing. But this Alton company is a defendant in a wrongful death suit filed as the result of the death of an employee who was working on one of the company's production lines. Like, egads, okay. Really, here we were just sailing along on a nice Tuesday afternoon, and now we got to start dealing with people being killed on a factory floor. But the plaintiff filed suit in June and has asked for damages of $3 million. Alton carries insurance for potential claims of this nature, but the insurance coverage amounts to 1.5. Legal counsel for Alton believes the judge will rule in the plaintiff's favor and that the company will have to pay $2.2 million, but the settlement could reach as much as $3 million. Okay, so what happens? We go ahead and we take the loss for 2.2. We take the liability for 2.2 because they're saying in that range, they're thinking that they'll have to pay about the 2.2. Now, that 3, it is probable that the judge will rule against because the estimated settlement is range of 2.2. We should recognize that contingency amount with disclosures indicating that it could be as high as 3. And then I want you to flashcard this part because we really didn't cover this in the outline. The insurance proceeds that may result should be treated as a gain contingency and not recorded until received. So you could footnote that you think you have this 1.5 of coverage, but you're not going to take that, debit the cash, and credit the gain until later on when you actually receive that insurance coverage. Because maybe the insurance company will balk on payment because maybe you didn't maintain the equipment or something. I don't know. Okay. Okay, good. Now you come over and you take a look at the discussion of potential loss contingencies. If it is probable that an uninserted claim will be filed, that is treated similar to any other loss contingency. And so, if you think you're going to be sued and you think you're going to have a loss on that, treat that as a loss contingency. And then, things like, the outcome of floods. Oh, when we think we're going to have a flood or something, hey, no one knows, right? If that's going to happen or whatever. So you don't have to do any disclosure on that. Okay, let's see. I'm showing about 6:20. I feel that we are. You want to take a break now or after we're done with this module? Anybody still with me? I know I'm alone. I'm talking to myself here. Hopefully I'm not talking to myself there. Break
I
now.
finished the module.
Finish the module. Okay. Okay. We'll finish the module and then we'll go ahead and take the break. Okay, good. So let's take a look at premiums and warranties. Okay, let's start with premiums. Now, premiums are offers to customer where they say, hey, give us box tops, labels, etc., and we'll give you, a nice little statue of, of an owl or something. And I'm saying that because they have the little owl thing sitting here. So that's basically what premiums are. And an entity needs to estimate what they think the liability is going to be for those premiums at the time comes that, the people are buying the product and either have already or potentially going to reclaim the opportunity for those little premiums. Okay. Now, I don't know, guys, this is reading comprehension. I don't have a flashcard for you here. I don't really know what to tell you. I don't want to waste your time making flashcards for things that, you'll read the question and you'll start to get used to this. This is more weightlifting than it is jogging, and that you read the question. Oh, I see how to do this. And then you can go forward and be okay with this. So let's just take a look though, get a little bit of that reading comprehension exercise under our belt right now. And so we say that they have a promotion that they kicked off August 31st, year 1. It's a redeemable coupon on each can of soup sold. 5 coupons must be presented to receive a premium that costs them, $2. I don't know what the premium is. A little soup statue. Okay, whatever. It's a Jolly Green Giant. You get a statue with the Jolly Green Giant on it or something. Okay. And AAA estimates that 70% of the coupons will be redeemed. Information available December 31st, year 1 is as follows. So they have 1.5 million cans, 200,000 premiums have been purchased, and 600,000 coupons have been redeemed. Okay. Now you come over and you say, well, look, we think that they're going to have a total amount, 70% of these, coupons get redeemed. And then we have already redeemed what, 600,000. Okay. And what coupons to be redeemed are for 50. So that means that what? That means that and it takes what? It takes, what do they tell me? It takes 5 coupons. Okay. So if it's 90,000, cans of soup, and we need to turn in 5 labels or whatever to get this thing, that means we're going to have to redeem 90,000, buy 90,000 of these little statues, whatever. So 90,000 times 2 gives me the $180,000. Given information about the premiums purchase was not used in the computation in determining the estimated liability. To be honest with you, I don't know what this means. Premiums purchased, I guess, means, premium little statues, I guess, that they have purchased. At the time that they purchased those little statues, and I'm just making the statue thing up, they would have credited cash and they would have debited some sort of supply inventory or something. And then, as they go ahead and, sell these things, or, go ahead and issue these things, I guess they would credit that inventory, and I don't know what they would debit here. That's a good question. Now I got myself. They purchased the premiums, they would have credited cash for 200,000. They would have debited premium, which I'm thinking is an asset, for 200,000. They have those sitting on the shelf. And then, oh yeah. And then I guess when they send out, then when the people come and say, hey, I want my little statue, then they go ahead and they debit the premium liability. I don't know, say, 100,000 worth of people come, and they would credit the premium asset, the inventory. Okay, but that's not the amount that they purchased, is not what the liability is based on their estimate of how many people they think they're going to come back to get these, and why they bought 200,000 of these things if they only think 180,000 are coming back. I don't know. Okay. Question. Okay, this premium asset, this is the account I'm talking about here. That's at the time that they buy those. So I guess they want them sitting on the shelf in case people come. Okay, all right, good. Now you come over and you take a look at warranties. Okay, why don't you flashcard that? There's something that you could flashcard for that the the amount that you've purchased of the premiums is not relevant to the calculation of liability. Okay, good. Warranties are sellers promise to, fix a problem with a product defect. And you have to record a liability, assuming that can be reasonably estimated. Note that the entire liability for the warranty should be accrued in the year of the sale, not when you pay out this warranty cost. You match it with the sale. Okay. So it's sort of like an allowance for doubtful accounts that we talked about, in F3, where you have to estimate what you think your uncollectible receivable is going to be and set up the allowance. Here, you're going to do what? And you take your bad debt expense. Here, you're going to say, well, what's my estimated liability based on my sales? And I'm going to go ahead and have to take a liability for that and take a warranty expense, but I match that with the period of sale. So we come over here and you have these different amounts of sales. Okay, and you've got the 250, the 500, the 750 for a total of 1.5 million. Now they tell us that what we have cost estimate of 2% of sales in the year of sale, 4% in the year after the year of sale, and 6% in the year after that, in the succeeding years. And ABC sales and actual warranty expense were as follows. Okay. Now you come over and you take a look, and the way they're coming up with that 12% for the sales of 250,000 for year one is they're saying, well, the 2% will happen in year one plus what? Plus the 4%, right, in year two, plus the, what was it, 6% in year three. So that's how they got to that 12%. And they do that, guys, year by year. Okay, as they make the sales, they say, well, 2% of the year of sale, and so on. Okay, and so they go ahead and they set those up year by year. Okay, and then they tell us that they had actual warranty costs of 10 in year two, 20 in year three, and 30 in year four. And so as you pay out, I don't know, you're replacing the product, sometimes you might have to debit salary expense because you're paying guys to fix the stuff, whatever it is. Okay, but you take those amounts in the period that you are providing whatever it is. Not salary expense. You wouldn't debit salary expense. You debit the liability, but you might credit cash if you're having to pay salaries for that, okay, or parts or whatever it is. Now we come over and they tell us that if you wanted to do the total liability, you could take that total 1.5 times that 12%, that would equal 180. And then if you wanted to figure out, well, what's the liability at the end of year three, you would have taken 180 into the liability, but you would have made good on 10, 20, 30 of that. You would have made good on 60,000 of that by paying out the, replacing the product, whatever it is, by crediting the inventory. Okay. Okay, good. So with all that, let's go ahead and let's take a look at a couple of questions, then we'll take the break. Okay, looks like everyone's had a chance to look at this one, so I'm going to go ahead and end the poll. But good work, guys. I mean, that's 100%. And that they didn't know about this 275,000 until after they had issued the financial statement. So they would have to do, let me see if I can stop sharing the results here so you can see the question. Okay, so you would have to do what? You'd have to go ahead and take that lower amount of the estimate between 200 and 300,000 because they don't know about this until after the statements are issued. Now, let me ask you this. What if this settlement happened before the financial statements were issued? Then what should they take? It says after they were issued here in the fact pattern. What if it was before they were issued? Then what amount should they have taken? Right here, the answer is 200,000, but what if it was before?
The 275.
Then it's 275 because now we're getting back into our discussion of what subsequent events. And if better information is available before the financial statements are issued, but something that it was a recognized subsequent event because the circumstances were there before, on or before the balance sheet date, then you would have taken the 275, right? But here you don't know that till after. So you go to your rule of contingent, you take the lower amount. Good. Okay, let's look at this one. Okay, it looks like most of us have had a chance to try this one, so I'm going to go ahead and end the poll here. And most of us got this right. The couple of key phrases, words in here, whatever, was that it said what? It said that it was reasonably possible. If it's reasonably possible, what's the rule? I don't have to book anything. I don't have to what? Accrue anything. So when they ask me, well, what should be accrued at December 31st? The answer is what? Answer is 0. If they had told me that what there was amount that was probable, and they tell me that the estimate, the best estimate is 400,000, then yes, C would have been right. But they didn't say probable. They said what? Reasonably possible. So we simply disclose, we don't have to accrue. Okay. Okay, looks like we got one more. Let's do that, and then we'll take the break. Okay, let's go ahead and let's take a look at this question. And most of us got this right. I mean, there was a song a long time ago called The Long and Winding Road, and that's what kind of comes into my mind when I'm reading this question. It's like, man, can you get to what you want me to answer here? And they kind of play hide and seek with, well, who are we doing the accounting for? Apparently it's Smith who's filed this lawsuit and thinks that they're going to get some amount of an award. Okay. They think that they'd be successful for an estimated amount in the range of 75 to 100,000. They say, how should the award be reported? So when I see award, I'm thinking they're thinking of Smith, the person that filed the lawsuit. And then I look at the choices and I'm like, yeah, okay, they're talking about somebody winning the lawsuit because they start talking about receivables and whatnot. Okay. Now, when you look at this in potential revenue, so they must be talking about doing the accounting for Smith. This is a gain contingency, and you do not book a gain contingency. So there is no recording of a receivable in a revenue or deferred revenue. Okay. Now there will be disclosure, could be disclosure of a contingent gain, but then you start getting up into the fact pattern and they tell us that all amounts in the range are considered equally likely. So there is no particular, amount that is called out as the most likely amount. So we would do what? We would book the range. So that's why choice D was correct. Okay. All right, guys, you'll get used to those questions, probably about 5 points on the exam, nothing that difficult. Okay. So when we come back, we're going to talk about the long-term liability, AKA bond payable, is really the big one that they're talking about there. I'm showing 641. So we get caught in that little in between time here. Let's go ahead though and make it, we'll make it 6:55. Go ahead and have it be on an even time. I guess that's giving us an extra 3 minutes or something. So we'll come back at 6:55. Okay. I'm going to pause the recording. Please remind me to start it back.
Professor, I think your mute button's on.
Okay, you can hear me now?
Yes.
Yeah.
Okay, sorry about that. Okay, so as what I was saying, you probably could, read what I was saying from what I was writing. Bond payable, 10 points on the exam, task-based simulation, multiple choice questions, yeah. And we're going to have to understand something about the time value of money. So let's go ahead and start off talking about that. And we're going to see that we're going to be dealing with present value of $1 and present value of an ordinary annuity, present value of an ordinary annuity, and sometimes you may see present value of an annuity due. So let's just go ahead and let's sort of compare present value of a ordinary annuity versus annuity due. Okay, now as you know, annuities are a stream of payments, for example, interest payments on a bond. Okay, and we'll be dealing with these present value that interest payments here tonight. And then we'll see next time present value of lease payments is also something we'll use sometimes. Now, to compare present value of an annuity due, and you say, well, why do I need to compare them? Well, sometimes the exam will give you the table for present value of an ordinary annuity, but they will tell you that the payments come out at the beginning of the period, which means it is a annuity due. So if you were to go, what is going on here? Why is it doing this? I'm not touching it. Okay. I don't know how we got all the way back there, but yeah. Okay. Now, if you were to look at this and you were to circle this and put today, okay, what that's telling you is that for the annuity due, the payments will come out today. Now, if you number these payments, 1, 2, 3, 1, 2, 3. What they're telling you here, when I'm writing this in, what I'm telling you is that the first payment of an ordinary annuity is the same as the second payment of an annuity due, and the third payment of an annuity due is the same as the second payment as an ordinary annuity. And the payment that comes out today doesn't need to be discounted because that's coming out today and there is no present value because we're already in the present. So what can you do with this observation? And so if you were to look at, say, a question like, where's the one I want? They used to have this organized a lot better than this, but we'll roll with it. Okay. Present value of an annuity due. Just let's look at this problem with that graphic in mind. Okay. And they tell us that the present value of an ordinary annuity of $1 at 6% for 2 periods is 1.83. The present value of an annuity due, they gave us that factor, and the present value. This isn't the one I want either, guys. I'm sorry. Hang on. I want to use a problem where they actually give me the dollar amounts in here. Okay, here we go. Okay, so what happens? We have this avalanche. This is the present value of an annuity due, and enters into a 10-year lease agreement requiring 10 beginning of the year payments of 100,000 each. Avalanche borrowing rate is 10% compounded annually. And they go to the present value of the annuity due table, which to me completely makes this example not even worth talking about until you come over and you look at the present value of the ordinary annuity table. For some reason, my computer's gonna make me find that file again, even though I already opened it. There it is. Okay, and I come over. And I come to the present value of the ordinary annuity. Now, they told me that the interest rate on that was what? Somebody remind me, it's what, 10%? 10%. And I come over, and when I look at this thing, I look at it for, let's use blue here, I guess. And it was 10 payments, but I'm going to go to the 9 payment row here. Okay. And at 10%, I come over and I see this factor of 5.75902. Okay. And so now when I go back to the problem, okay, if the exam only gave me the ordinary annuity factor, which sometimes they'll do that, okay, well, I would have seen that that factor was what? Was 5.759. I would have multiplied that times what? 100,000. That would have given me 575,900. But then I would have simply done what? Added in that first payment at 100,000. So I could come up with the what? I could come up with the present value of the annuity due. Even, the problem tells me at the beginning of the year payments, it's annuity due, but then they'll say the factor for an ordinary annuity is 5.759, and you'll want to cry because you're like, well, I need the factor for the annuity due, not the way they did it here. They gave you the correct factor. But what I'm saying is if they gave you the ordinary annuity factor, then you could go ahead and you could still answer the problem by just adding in, okay, that 100,000 payment, which doesn't need to be discounted. Okay, question? Okay, so I'm just telling you that in case you run into something weird like that. Okay, let's go ahead then with that quick little discussion. And let's see. And this is usually what they'll do with these present value questions, guys. The tables are available as a tool when you're working your task-based simulations and stuff. It's there for you. But usually what they'll do is they'll just give you the factors and they want to see, do you know what the right factors are to choose? Okay, so that's what they were doing in this particular question. So let's go ahead and I'll give you time to work this one. Okay, looks like most of us had a chance to work this one. And I'm going to end the poll and share the results here. And okay, pretty good. Most of us got this right. Okay, now what happens? You look and they're asking for what is the amount of the receivable? Well, if they received what? The December 31st, year one, they sold a machine and they're going to get 10,000, 10 payments. And the first payment was already made at December 30th, year one. That means that's not receivable because they already got that. So what I need to get is what is the amounts, the present value of the amounts that are going to be for the next 9 payments. And so I can go ahead and use the ordinary annuity because the end of period 1 is the beginning of period 2 in a annuity due situation, which is what we have here. So I would go ahead and I would take that 10,000. I would multiply that by the factor here, 6.25. That gives me what? That gives me 62,500. That's the present value of the payments now that they will be receiving at the beginning of year 2, which is the end of year 1 in an ordinary annuity. And we only have 9 payments coming of those. Now, if the question said, well, what's the, present value of all the payments, or what's the amount that they should book as a sale on this thing? Well, then I would have to do what? I'd have to take that 10,000 and put that on at 72,500, because that's the present value of everything that they are getting consideration for this machine, whatever it is. But that first 10,000 doesn't have to be discounted. Okay, so the answer here is what? C. Okay, now when we look at, and that's kind of a little oxymoronic because they're asking me about note receivable, which is an asset, and we're supposed to be talking about liabilities here. But anyway, okay, so let's go ahead and let's turn our attention now to liabilities. Okay, and we can have what? Note payable, bond payable, long-term lease. We'll talk about long-term leases, guys, next time. Actually, I'm going to throw that out to you as to how you want to approach that as we start to get into some time crunches here, but not tonight, but going forward. I'm going to ask you towards the end of class what you wanted. Well, let me ask you now, if you had to choose, would you rather me talk next time about deferred taxes or long-term lease liability? That's a question.
Long-term lease.
Leases?
Yes.
Okay. Because I may turn you loose on the deferred taxes, is what I'm saying. When I say turn you loose, put you on your own so that we start to catch up. So if I couldn't cover one of those, you'd say it'd be better if I didn't cover the deferred taxes versus the lease?
Yes.
Yes, I think so.
Okay, good. Thank you, guys. That's helpful. Okay. All right, let's go ahead then and let's take a look at note payable. Okay. And when we look at note payable, okay, I just want to review with you. I'm not trying to strike it out. I'm trying to highlight it. How you will amortize a discount. Okay. And I'm putting this, I think maybe you know how to do this already, but I want to make sure that, you don't get stuck and say, geez, there's a bunch of problems here on how to amortize a discount. Meanwhile, we didn't say much about it. Okay. Now, what I want you to look at is the discount is inseparable from the related note and is added to the note payable to determine the carrying value to be reported on the balance sheet. Okay. So let's just go ahead and let's take a look at this situation. And they have this company A making 3 annual loan payments of $1,000 each to company B. There is no stated rate of interest. The present value of the aggregate loan payment at the appropriate interest rate of 10% is $2,486. So what they're saying to you when they describe that is that this company got cash. I'm going to just write the journal entry for this up here. The company got cash of $2,486 $486. Okay. And then what? They have a note payable of 3,000. And they have a discount on this note payable of $514. That's the difference, obviously. Okay, 514. Now, if I were to tee up, I'm not going to tee up the cash here, guys, but if I were to tee up the note payable, that's sitting there at 3,000. And if I were to tee up the discount is at 514. Okay. Now I start to take a look at this thing, and I'm going to move this over a bit. You'll see why in a second. Okay. Now, as I start to take a look at this thing, they tell me that it's 10%. Okay. So what I want to do is figure out the interest expense for the first period. So I would go ahead and take this note payable, and on the balance sheet, I'd have note payable of 3,000. I have discount of 514. And I import the note at present value. Net note payable is this 2,486, the amount of cash they got. Okay, now what I do is I take that 2,486 right there, okay, and I multiply it by what? By 10%, which was the interest rate on this thing. And that means that my interest expense, give or take a few cents, is what? Is $249. Okay. Now, since I'm making a payment each time of $1,000, I'm going to be paying principal on this thing of $751. So the what? The 1,000, the 2,486 minus the 751 here is going to give me a carrying value of this thing now of 735, because 1735, because I paid that down. So to look at how I would record that, I'm going to obviously now do what? I'm going to credit the cash for 1,000. I'm going to debit the note payable for 1,000, bringing that note payable down now to what? To a balance of 2,000. Okay. But at the same time, I'm going to have to debit interest expense. And when I debit interest expense, I have to debit it for what? 249. And I'll credit the discount for 249. Okay. And I go ahead, and when I credit the discount. And when I credit the discount for 249, how much is in the discount account now? 265. Okay. Now I'm sitting there and I'm saying, okay, well, I have note payable of 2,000. I've got discount now of 265. 2,000 minus 265 should give me 1,735, give or take.
Yes.
There's obviously some rounding going on here. 1,735. Okay, that's the carrying amount of that note for the next year. And so I'd multiply that by 10%. And now I get interest of this 174, give or take, however they're doing that rounding. I don't know, but I don't care, because we're in the ballpark as long as we're understanding the process here. Okay? Question? That's how you amortize the discount on a note. That's the takeaway from that. And I think my pen is the thing that's doing this. My pen is freaking out on me, I think. Or maybe my mouse, maybe the wind is blowing my mouse and I don't know it. Okay. Okay, good. That's all I wanted to do there. Okay. Question? Okay, good. And they give you the whole schedule down here, but you don't have to worry about all that. I think you get the process. Okay, debt covenants. Debt covenants are put in place to protect bondholders. Okay. And it says stuff like, hey, you can't borrow so much money that I'm not going to get paid. You must maintain a certain debt to equity ratio. In other words, we want to protect the bondholder so that we don't have so much debt that there's nothing available to pay. Debt to capital ratio. All of these are covenants. And often what a covenant will say is, hey, if you don't, meet these debt covenants, then we're going to make you repay the debt at that point in time. Okay, those are debt covenants. And an example here is where they say, hey, you have to restrict some amount of cash. And remember, guys, we talked last time, I don't know about last time, but a few times back, where if you have restricted cash like this, okay, they say you have to restrict a certain amount of cash, then what would happen is that cash would be reported as what? It would be reported as non-cash equivalent if that restriction was legally binding. You actually wouldn't even count that as cash. Okay. Okay, good. Let's go ahead then. Let's take a look at a couple questions here. Okay, guys, we're heading into 3 minutes on this, so I don't want to take a whole lot more time on this one. So I'm going to go ahead and end the poll and take a look. And okay, about 80% of us got this right. This is, though, something that you can expect a fair number of questions on your exam, looking at how to amortize a note like this. So they tell us that what we're sitting here and they borrowed $1 million, and the first of 4 quarterly payments of $264,200 when due on December 30th was made, and it's December 31st balance sheet. What should they report as the note payable? Now we're sitting there and they said, well, they borrowed what? They borrowed $1 million. And they tell us that what the interest rate on that is 0.09. And they borrowed the money on September 30th. So that's all of October, all of November, all of December, because they're asking me at December 31st. So now I go ahead and I multiply that by what? 312. So we assume a 360-day year, because we assume every month has the same number of days, right? So that goes ahead. And that gives me now interest expense of $22,500. Now, if I think about the journal entry on that, I know I have to credit cash for what? For $264,200. I know that's happening. I know now by my calculation that I have to debit interest expense for the $22,500. I know, therefore, I need a debit to make this journal entry balance. Of course, I am a horrible space manager when it comes to writing on this thing. The credit to cash is $264,200 per the problem. So if you look at $264,200 minus $22,500, that difference is going to go towards the note payable at the amount of $241,700. So I'm going to debit what? Note payable to, and I'm not lining my numbers up very well, $241,700. Debit interest expense, I'll write that a little better, 22,500. Right? And so if the note payable started out at what? Started out at the $1 million, write it up here. And I just debited it for what? For $241,700. Then the remaining balance on that note payable should be $758,300. Okay. I promise you guys, you're going to see a bunch of questions like that. You want to get good at that because these questions can, be difficult. But then if you practice enough on them, they can be easy and you'll pick up a nice time because the examiners are thinking, it's got to be my pen. They just started that. And I don't know why. Because when I do this is when it does it. I can't tell you why it's doing that. Okay. I mean, it really screws up when it screws up here. Now, I don't feel like rebooting right now, so I guess we're going to have to live with that for the rest of the class. Question? Where am I now? Okay, let's look at this one. Question 3. Okay, looks like everyone's had a chance to try this one. I got all 11 of you on this one for some reason. I've been getting 9 before, but it looks like everybody's back. Okay, so that's good. And yeah, everyone got this right. Okay, it's pretty easy. Debt to equity. Okay, so they tell me that they had what liabilities 55. And stockholders' equity of what? 95.5. I mean, okay. I mean, may you get 52 questions like this on the exam. That gives me what 0.5759, which is what close enough for government work for choice B. Okay, debt to equity. Guys, in chapter 7, there's a whole module on ratio. And I'm telling you now, if you want to look at that module now, go ahead and look at it, because I'm not going to go through that module on ratios and read off to you 52 ratios. Okay, because that's basically what it comes down to, is have you memorized the different ratio and can you apply them to a question like this? So we get into that. Let me double check that I'm saying the right chapter. Huh. Oh, no, I don't know what chapter it was in. It used to be in chapter 7.
If you're talking about equity EPS, then chapter 7.
I'm talking about what?
The chapter 7's equity EPS.
No,
and-
no, I'm
no?
talking about one of these chapters they just splatter a bunch of ratio at you.
I think in chapter 2, module 7, it was like that.
Oh,
So
is that where it was? And I already told you to look at that? Okay, sorry.
Mhm.
I already told you to look at that. Okay, yeah, so where they just go through and they give you the ratios one after the other, make sure you look at that on your own, because they could ask you a question like this, and I don't want you to miss something because you don't know one of the ratio. Okay. Whatever chapter that is, you're saying it's chapter 2?
Yep.
Okay, thank you. They used to have it at 7, but I guess they moved it. Okay, good. Let me take that poll down. And let's go ahead now and let's move into bonds. Okay, now when we look at bond, okay, we're going to see that that's 10-point area. It's a very common liability. We're going to be looking at the face amount of the bond, and when we calculate the periodic interest payments that are paid, it's always on the face amount. Okay, we'll take that face amount and we'll multiply it by the stated interest, okay, coupon amount. Sometimes, I don't see it too much for the CPA exam, but I have seen some accounting textbooks that will call that the contract rate. Okay, now, when we calculate the actual interest expense, we will use the market or effective rate of interest. But I've also seen, and this I do see on the CPA exam, I've seen it called the yield, okay, rate on these bonds, okay? And that's what we will use to actually calculate our interest expense, okay? A bond could be issued at a discount, which means it'll be issued at less than face, or it could be issued at a premium, which means it'll be issued for more than face. On the exam, as we go through and look at these things and we look at the different types of bonds, we will be looking primarily at term bonds. There'll be a little bit of, do you understand what a serial bond is? But for the most part, we're thinking about term bonds on the CPA exam. Okay, so term bond means that the bond has a fixed term. Okay, and so we take a look. And let's just look at this little bond that we're going to be using here. We have the face of the bond. In the old days when bonds were printed, nowadays they exist in book entry form, but the way to think of the face, it would be printed right on the face of the bond. Nowadays, bonds just exist as a computer entry somewhere. Then you would have the interest rate, and the interest rate, I'm not sure who's Can I get you to mute everybody? And, then if you want to talk, go ahead and unmute. Okay, good. I get everybody muted. Okay. And then we have the interest rate. The interest rate, as I said, it could be called the coupon rate. It could be called the stated rate. Not so much on the CPA exam, but I've also heard it called the contract rate. Okay, now this rate will not change. That rate will not change. The face amount won't change. The 5 years for a term bond, that's the term. Semi-annual means what? 2 interest payments. Okay, and in this example, June 30th and December 31st. Okay, now when a bond is issued, it could be issued at par, but usually a bond is going to be issued at a discount. In other words, if it's issued at a discount, it's going to be issued for less than face. Okay, now the reason it's issuing for less than face is that the market rate, which I'm abbreviating as MR, the market rate of interest on this is 12%, while the stated / coupon, I'm just going to leave it at stated or a coupon. I'll write it that way. Stated or coupon rate is, as we've already seen, 10%. So what happens? The market rate is greater than the stated or our coupon rate. And so someone looks at that bond and they said, well, I'm not going to pay the full amount for that bond because I'm only going to get a 10% return when the market rate is requiring 12% for a bond of this nature. So when we determine the selling price, we need to look at that stuff that I just wrote is what's here. Okay, semi-annual bond, 10%. We already saw that. $1 million bond, 2 interest payments, semi-annual, June 30th and December 31st. And then the new information they gave us here is that the market or yield rate is 12%. Okay, that's where I got that. And so someone looks at that bond and said, I ain't paying you the full amount for that bond because the market is requiring 12%, you're going to only give me 10%. Now, in this example, they gave you a bunch of factors. I don't know that the exam would give you all these factors, but they might expect you to tease out the right factors from a listing of factors, because we have to figure out what is somebody willing to pay today, present value, for the right to receive the interest payments plus the principal when this bond matures 5 years from now. Now, when we look at the interest payments, we take the $1 million, we multiply that by the stated rate of 10%, but we divide that by 2 because it's a semi-annual bond, has 2 interest payment dates. So that gives me this $50,000. And that $50,000 is going to what? Is going to come in every 6 months for the next 5 years. So when I count up those payments of $50,000, they're going to come in every 6 months for the next 5 years. That's 10 payments at $50,000. So I start looking at these 10 periods, and this is a stream of payments. So it's an annuity. And when I look, I got the choice of what? Either 5% or 6%. I use what? I use 6% because I discount at the market rate of interest, which was 12% divided by 2 gives me 6%. So to calculate the amount of the interest, I use what? The coupon stated rate, whatever. To figure out the present value of those payments, I use the market or the yield rate or whatever else they may call that, market yield rate. Sometimes, as I said, well, usually they may call it the effective rate. Okay, good. So I go over and I get that factor right there. I know I have to choose that factor for the interest, but they are also going to get back what? The principal at the end, or have to pay back the principal at the end of this, since we're doing the calculation for the borrower. The principal is a one-time payment. Okay, so what do? Again, I pick up that market rate for 10 periods, but I use what? Present value of a single payment, which is what the principal is. It's a one-time payment, so I don't use annuity. Annuity is a stream of payments. I have to use the present value of the dollar for that. So I go ahead, and once I've teased out those factors, I apply that one for the interest, right? Apply the one for the interest to the interest payments, which are 50,000 every 6 months, right? And then I apply that factor for the principal to the principal. And that means that somebody is willing to pay $926,399 for the right to receive what? $50,000 interest payment every 6 months for the next 5 years, or 10 of those, and then the one principal payment when this thing matures. Now, looking at the journal entry for the borrower will do what? The borrower will debit the cash, right, for the 926. They will credit the bond payable for the full million, and they will debit the discount on bond payable. Now, if you were to look at that on their financial statement, you would see what? You would see on their balance sheet, you'd see bond payable of what? $1 million. You'd see discount. Sometimes they'll just report it net of discount, and they'll disclose the amount of the discount in a footnote. But for our purposes, just to see how that's going to affect the balance sheet. And then I'd have net bond payable of this $926,399. And it makes sense that we received less cash than what we're going to have to ultimately pay off, because what? That's catching my investor up for all the time that my bond was only paying a 10% interest when the market was requiring 12%. I say, okay, give me 926. And then when the thing matures, I'll give you $1 million back. Okay. Okay, good. Now, if it is a premium, with a premium, now what happens? With the premium, now the market rate, which in this example was 8%, is going to be less than the coupon rate, stated rate, whatever you want to call those, different terms for the same thing, is 10%. Well, now everybody's lining up to buy my bond because they're saying, wow, that's a great deal. So I said, well, you know what? If you want this, you're going to have to pay me what? A little bit more than face. Okay, so it's the same bond now, but all they've changed is the market rate is what? Is 8%. Everything else is the same. Okay, so the thing that will not change, 50,000 is like your best friend, right? You tell your best friend, tell me you'll never change. Okay, I'll never change. So we take the what? $1 million times the 10%, but we divide that by 2. That gives me the 50,000. That 50,000 is going to come out regardless of what happens with the market rate when we issue this bond. The 50,000 is coming out. And then, what are they trying to do? Mess us up here? That principal payment is what? Is $1 million. Did they make that same mistake up here? No, I didn't catch it. No, they made it down here though. That's supposed to be $1 million, right, guys? The principal when it pays back, not 50,000. It's a typo. Okay. Okay, good. Now again, it's what? It's 8% is the market rate, but I divide that by 2. That's 4. And it's what? It's 10 payments, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So I have to sit here, and for the what? For the principal, I use the present value of the dollar at 4%. That's for my principal. For my interest, I use the present value of the annuity. And then I go ahead and I do the math on that, taking the 50,000 for the interest times that 0.8110896. And for the principal, I use the present value of the dollar factor at 4% for 10 periods at 0.67, 5564. And when I do the math on that, I get this 1,081,109. In other words, what? Someone is willing to pay a little more for this bond because the bond is going to be paying a 10% return when the market is only requiring an 8% return. So the borrower will debit the cash they get, they credit the premium, and they credit the bond payable because ultimately they're only going to have to pay back that $1 million. The book made a mistake. They should have put $1 million there. Okay, now when I prepare the balance sheet, I have what? I have premium. I have bond payable. Bond payable always shows at face. And then I have what? I have the premium. I add the premium to give me the carrying value of that bond, or book value of the bond. Carrying value, book value are synonymous, of 1,081,000. What is it? 109. Okay. Okay, good. Now with that as an understanding, let's go ahead and let's take a look at some of the terminology on the next pages. Okay. And stated rate, also called what? Also, AKA coupon rate. Sometimes you'll see it called that. Sometimes you'll see it called the contract rate. Okay. The stated rate of the bond does not change regardless of the market rate. Okay. The amount of cash received by the bondholder, regular interest intervals throughout the life of the bond, will always be the stated rate applied to the face amount of the bond. And in our little example, that was what? That was the $1 million times 0.1 times 1/2, or what? 50,000. That's not going to change. I don't care what happens to the market rate. The effective rate of interest, here they're calling it effective rate. Okay. Could also be called what? Market rate. Could be called what? Yield. Market rate. And in our little example, it was 12% for the discount bond and 8% for the premium bond. Okay. Just hearkening back to our example. Okay. Discount happen when what? When the market rate, in our little example, 12%, is greater than the coupon / stated rate of 10%, which is not going to change, right? Then the bond will sell at a discount. It'll sell at what? Less than face. Okay. And so you can see down here, guys, they go ahead and they show you what I kind of wrote up there, what the balance sheet would look like right after the issuance of a discount bond. Okay. Now we're going to get into amortization of discount here in a little. Yeah. Maybe not tonight, unfortunately. Premium. Okay. If the market rate of interest is lower than the stated rate of interest, the bond will sell at a premium. And that's what we had in a little example. We had the what? I'll write it down here. Market rate was 8%. And the what? It was less than the coupon rate of 10%. So the bond sold for what? More than face. Okay. So we showed you in the example, and we showed you, here in the pros, and you can see here how they added the premium to the face to get the carrying amount of the bond. Okay. So when you look at carrying value, guys, and I want you to flashcard this, when you look at carrying value, and it's got to be one or the other. It's either the face plus an amortized premium, or it's the face minus an unamortized discount. Got to be one or the other. Can't be both. Okay. Now, bond issue costs. And bond issue costs are costs that are incurred to bring the bond to market. You can't go on a street corner and say, hey, buddy, you want to buy some bonds? You have to go through a proper process, and there are underwriters who charge you for that. different fees, accounting fees, legal fees, etc. Okay. Now, bond issue costs are presented on the balance sheet as a direct reduction to the carrying amount of the bonds, similar to a bond discount. When bonds are issued, the proceeds are recorded net of the bond issue costs, and bond issue costs are amortized as interest expense over the life of the bond using the effective interest method. And we'll talk about amortization here a little bit later, but let's just go ahead, probably next time, because time's getting short here, but I want to get through this module. So let's go ahead and let's take a look. And they tell us that, you know, the bond issued at a discount, they were supposed to get $926,399, but because they had to pay these bond issue costs of $20,000, what happens? And so we go ahead and you have to take what, $926,399 minus $20,000 means they're going to get what? They're going to get cash of $906,399. The bond payable always gets set up for $1 million. So the discount is the difference between the amount of cash you got and the face of the bond payable, because you're gonna have to pay back at face. And so that discount now is $93,601. Or you could calculate it by saying, well, what was the discount, the face versus what the bond sold for? And then that discount is deepened by the amount of the bond issue cost. So you'd simply add that on to the discount before considering the bond issue cost, and that gives you the amount of the discount. Okay, so you can see that then the balance sheet would look like that, and notice the net is upon issuance anyway is the amount that you got at the time that you issued the bond. Okay. Okay, good. Now, sometimes you could have deferred bond issue costs. And that's basically saying, well, look, I incurred the bond issue cost before the issuance of the bond. And so they are going to be seen as an asset essentially until I issue those bonds. So you take a look here, and they issued incurred bond issue costs of $20,000 on November 1st before they issued the bond. So on November 1st, they credit the cash for whatever they're paying the underwriters and whatnot. They debit the bond issue cost, and then when they go ahead and they get the cash on those bonds, what they'll do is they'll go ahead and take that whole amount of cash that they would have gotten. They go ahead and they do what? Take away that asset, because now they receive that in the form of cash. You're going to, credit the bond payable and the for the full face amount, and then the discount is again that $93,601, which was still what? The $73,601 plus the $20,000, that instead of it being a reduction of cash at the time of issuance, it was a reduction of your cash as you set it up before the issuance, and then you liquidated that deferred bond issue cost asset, when you actually went ahead and issued the bond. Okay, let's go ahead and let's take a look at, this question one is not put in the right place. So I can't help you with that question yet, because it really should be at the end of module 2. So what do I want to do here? Let's work. I don't know. It's so annoying. I mean, let's just look at this one. The market price of a bond issued at a premium is equal to the present value of its principal amount and what? And the present value of future interest payments at the market rate of interest. Okay, so you would have to go ahead and take the present value of all future payments, both interest, present value of all future payments, future the market price of bond issued at premium is equal to the present value of its principal amount and the present value of all future interest payments at the market effective rate of interest. And we saw how that was calculated. Okay. Okay, guys, I'm stopping because I can't get through the next module, and question 2 really properly belongs in module 5, and I'm not prepared to do that. So we don't have time. I'm prepared to do it, but we don't have time. I don't want to sit here till 8:30. So we will reconvene on Tuesday. We'll do module 5. We'll do that modules that are left, module 6, whatever. We'll finish chapter 5, and then we will do leases, and we'll probably only have time for leases in module 6 in the class in general. So what you could do is look at deferred taxes for module 6 on your own. And then next time we'll wrap up chapter 5, and we'll wrap up leases for chapter 6. And then we'll just continue to chase ourselves through the rest of the materials we get ready for our exams. So work the first few modules that we've covered so far for chapter 5 and up to including module 4, not module 5. We'll do that together next time. And then look at chapter 6, the deferred tax module. Look at that on your own, and then we'll do leases next time per your suggestion. Okay. Question? Okay, guys, I will see you next Tuesday. I'll be back home, and we'll see you. Okay.
Thank you.
Thank you. Have a good night.
Thanks,
Bye-bye.
Professor.
Good night.
Prof.